Welcome to the Value Investor TV podcast. This is the podcast that helps you grow your wealth and become financially independent. My name is Becco and my partner, Hari.
Hello.
How are you guys today? I hope you're doing well. I hope you're enjoying your day. All right, let's get started, Hari. So this is a continuation of our discussion around spinoffs, and spinoffs are really interesting fertile ground, like Hari likes to say. It's a fertile ground to look for great opportunities, great investment opportunities. And we talked about at a high level what spinoff is, why it's so attractive. But in this episode, we'll dig deep into some of the checklists, some of the checkpoints, questions you have to ask yourself when you're analyzing spinoff situations. Like we talked about in the previous episode, there's an incredible amount of downward pressure on the price of the spinoff when they're born, when they actually do spin off and exist as a separate entity. And that creates a lot of great opportunities if the underlying business itself is fantastic. So there are things that we have to go through to make sure it's a good company, good investment opportunity, and we'll do that in this episode. But before we do, Hari, would you like to give us a quick disclaimer?
Yeah, the Value Investor TV podcast is here to help you learn how value investing concepts. We are doing this for educational and entertainment purposes only. We are not a financial advisor, nor do we know your specific financial situation. So if you are making any investment decisions, please consult with a financial advisor before doing so.
Awesome. Thanks for that, Hari. Let's get started on this. Okay. How should we do this? Should we go down the checklist that we have here, Hari?
Yeah, I think it's a good place to look or to start. Is when you have the parent and the child, is splitting these two businesses up, is that going to benefit? Is it going to allow the investment universe, Wall Street, to really be able to assess these two businesses better? I think that the way that you would kind of think about that is, if they're two businesses in different industries, that's probably a good place that you would want to do this. If one business can change into a different tax entity, like a real estate investment trust, which we talked about in the previous episode, those are the kind of things that you're trying to look at. Are they completely different areas, or are they, is there some regulatory hurdle that they can cross, by splitting up? That's kind of what you're looking for with these two business entities. Mm-hmm.
I also want to point out, from kind of tagging along, harping on that point a little bit further, Hari, is that this is something that I mentioned in the previous episode, but I want to reiterate here, is that spinoff is not indiscriminately a good opportunity. It's an opportunity where there are many good opportunities, but it's not every spinoff is not a good opportunity. So there are instances where the parent company will dump their subsidiary and load it up with debt so they can have a clean balance sheet. The parent company could have a clean balance sheet because all their debt is now with the spinoff. So these are situations where you don't want to get into spinoff investing. So all that to say that spinoff is a good opportunity to look, but it's not blanket statement. It's not a blanket opportunity to go in there and just buy indiscriminately. So I just want to make that clear for everybody who is listening.
Yeah. I think that's an important one to consider. I think of, off the top of my head, Community Health, which is a hospital system, spun off, I think it was called Quorum Health or something like that, which was loaded up with debt. Both entities were saddled with debt. I think there's been no appreciable returns from either asset as a result of the spinoff, and it's partly due to the fact that the underlying businesses were terrible, right? I mean, they were just entirely over leveraged, and so there was no real way to get rid of the assets to kind of make them grow. So that's it's not always, a complete answer there, is spinoffs, but it's a great place to look. So
yeah, I'd also say this: it might be the case that there are many different combinations. It could be a good parent company spinning off a bad one. That's what we just talked about there.
Yep.
There could be a case where it's a bad parent company but spinning off a really good one. It could also be the case that it could be a really good company and spinning off a good company. So there could be many different combinations. I just want to point that out because, by spinning off, for example, Laquinta into two separate entities, from my perspective, it was a good business and it became great businesses. I
think another good example of that is PayPal was spun out of eBay. So eBay bought PayPal, I think, in the early 2000s or mid 2000s, have owned it, and then these are two different industries, right? I mean, payment processing and online auctions. Spun off PayPal. PayPal, I think, tripled, doubled or tripled in the next year or two after eBay spun it out. So good business. Both with high returns on capital, but PayPal was underappreciated under the eBay umbrella, and so spinning it off is a good use of unlocking value.
Yeah, I think you mentioned something that was really interesting. I think we should reiterate that spinoff happens a lot of times when, like you mentioned, it's two separate businesses, two separate industries, right? Retail industry versus insurance industry, like we talked about with Sears and Allstate. Those are kind of good examples of a place where spinoff could be appropriately applied. So you want to look for those, and you also want to look for a situation where the parent business is too complex to analyze, to really unlock, to really understand the full value of things. So we talked about this in the previous episode, but you want to make sure that the spinoff is taking place in a situation where there is value to be had. So a value to be had, in other words, is, for example, if you have a subsidiary of a big company that's really too complex to analyze, and if it's too complex to analyze, you're not going to realize the full value of the parent company. So that's another way to kind of look at this. So I want to mention those two things before we jump into some of the more nitty-gritty details. So the next thing on our radar would be earnings volatility for parent and child. Do you have any thoughts on that, Hari?
Yeah, if they're operating in different industries, or one business is cyclical and has, is highly tied to how the economy is doing or something like that, and another business is more steady, you may see by splitting them up, you may get better returns for both industries, right? And so it's there's different types of volatility. High volatility and low volatility companies, it's potential for unlocking value there. Yeah, I think the cyclical nature of a subsidiary or cyclical nature of a parent company could definitely impact the partner, right? If a child company is cyclical and the parent company is not cyclical, it's going to have a huge impact on how you analyze the entire parent company. So it might be, in that situation, it might be really reasonable and make sense to spin off the child company at its own. So those are situations that you would have to look for. Another kind of element in our checklist is the valuation method. So I think this is really interesting. So if a parent company has a lot of depreciation expense because, for example, it's an asset heavy business, and the child company doesn't have any like depreciation expenses, that could really skew how you value the parent company and the child company. Yeah. If it is all under one umbrella. And so, what sort of valuation methods are you using? What sort of accounting, what measurements you should be using to analyze companies? I think that really has a big impact on how you analyze the entire business. Yeah, and we had talked about Laquinta and CorePoint in the last episode. CorePoint is the real estate holdings of Laquinta, and typically the real estate is, based on a capitalization method, like, what is the percent return based on assets that you're trying to get. So dividend yield, that kind of stuff, is kind of what you would look for in a company like CorePoint, and is trading at CorePoint is trading at a very low book value, whereas their management company was, is supposed to be a light asset, business. So spinning it off allows them to get tax advantages for the real estate, business. So you would kind of value these two things very differently as separate entities. And that's, potentially where, there's value to unlock. The other thing could be if a company has, if its company is a very tech-heavy business, so they don't have any assets, but then they also own some sort of, I could think of it, they own data centers that they want to spin out. So the data centers would be the asset-heavy business. The tech company would be the asset-light business. If you imagine Amazon tried to split up EC2 from the parent business, that would be kind of where you would see different valuation methods for the two businesses. So that would be kind of a good place to see some discrepancies in how one or the other is valued.
Yeah, I think that's a really valid point there. Like Amazon, for example, it hits me right. It paints a clear picture for me, right? So you have this asset light e-commerce website, business, and then you have EC2 where you're serving up this massive infrastructure projects where you have server farms and making sure all that is working. So that kind of paints a good picture for me, Hari, there. Let's move on to the next bullet point, which is the downward pressure. We talked about this in the previous episode, just a little bit, on indiscriminate selling that happens. And indiscriminate selling that happens because the child company is no longer part of the index, or the child company is now, trading as a new entity, and people have no interest in owning the child company. They're only interested in holding the parent company, which is what they originally purchased. Yep. So there might be indiscriminate selling that happens, and this is what we talked about. But there are other things at play, other elements that are at play that will exert downward pressure. Could you talk about some of those things, Hari?
Yeah. So one of those things is that, management will see an ugly business or present the business as somewhat ugly while it's attached to the parent. And so they'll provide pro forma financials as a standalone business, even though they're still attached to the parent company. And the reason that they want to make it look ugly is a couple of things. Management may be incentivized, and this is something that you can easily look at, is what is management's financial compensation structure. So they may want to keep prices very low initially, so that when they're issued options, there's a lower strike price so that they benefit from the upside of the share price going up. They may also have direct compensation related to the share price, targets as well. They also may have certain quality metrics that they have to hit, like earnings per share numbers or things like that. So they may initially sandbag these values just to improve their. We're not talking about doing this illegally, right? This is they are making the numbers look ugly, within reason, right? To make this, within the law, and within accounting rules. If we're going back to our CorePoint kind of example, CorePoint talks about this as they're remodeling a bunch of their stores. They got, or their hotels, as part of the spinoff, they got money from Wyndham to do the remodeling. And then in the future, they can charge a higher price once the remodeling is complete. So this is kind of a way from them to go from a low mid-tier hotel chain to a mid to high tier, upper middle tier high hotel chain. So the assets are the same, but they're actually able to make more money off of the same assets, right? So that's kind of what you see there is that they're trying to make it initially look bad because they've got these hotels that are not remodeled yet. They're looking really bad, but the asset is still valuable. It's just needs to be cleaned up a little bit.
And also, while it's being cleaned up, right? While it's being cleaned up, you're not going to make a lot of money because you have to shut down the hotel. Right. So at that point in time, you're not going to make money. The earnings is going to go down because you have to shut down the hotels for renovation. So when you have to shut down hotels for renovation, no money coming in. From outsider perspective, from investor perspective, when you look at these numbers without any sort of context, you say, oh, wow, their business is really falling apart. I'm going to sell this business. I have this Laquinta. Laquinta spun off this real estate thing, and the real estate thing is not making any money. So you just dump it. So there's a downward pressure because people are selling, and that downward pressure comes from the management sandbagging the numbers initially.
Yep.
And the reason for them to sandbag is because, like Hari talked about, their management incentive structures is set up so that if you start out low, think about this. If you're starting out at, earnings of, let's say 100 million, in order to double your earnings, you have to go to 200. But if you start out at 500, if you want to double that number, you got to go to 1 billion. So starting at a lower number gives them a huge advantage in terms of their own incentive structure. So this is insider, the operators, the CEOs, the CFOs, the COOs of the company. Their incentive structure is tied to the performance of the company. And so what they're doing initially is they are sandbagging the numbers so that their incentive package looks great. They can reap benefit from the incentive package. And because of that, the byproduct of this is that from the outside, it looks really bad because they're artificially, sandbagging the numbers. So from the outside, people are not really excited about this company, so they start dumping it. So it's kind of both ends. It's the insiders and then the outsiders. So in summary, insider really wants it. They have all the incentive structure, the right incentive structures, and the outsiders, they do not want it because at least on the surface, it looks bad.
Yeah, and another good way to tell is if you have management, where does that management come from for the child company? So if you have a child, if the CEO of the spinoff company was actually the CEO of the parent company, that kind of tells you where the CEO sees value, right? The CEO is going to look out for one person, that's himself or herself, and they're going to follow where the money is going, right? And so they're going to craft the incentive structure with their board for the new company so that they maximize their own return, right? And that may be through stock options, that may be through cash bonuses, that may be, and so you want to see where is the management for this new entity coming from? What are their incentive structures that are going to allow for them to maximize their return, right? And so in a business that's a good spinoff, you would want to see the new CEO of the spinoff to be, high level person or even the CEO of the parent company, and they're moving over because they see value in the new business, right? And then the other thing is that you look at their incentive structure and you say, are these things that they can achieve, and what are those targets that, what are they going to do as part of the initial few years after the spinoff to make that occur, right? And so in Laquinta's case, it's clean up the business model, upgrade the existing assets, add some, spit polish onto them, and then charge a higher price, right? So,
yeah,
I think that's a real good way of kind of seeing where this is going to go, right? Is starting with that.
And I think you mentioned something really, really fascinating, which is, where is the management coming from? Who is filing the rank and file of the parent of the child company? Where are they from? Are they totally an outsider? Are they hiring from someone, some other company, or are they part of the parent company? And a good example here I want to mention again, we're using the Laquinta example because it's such a good example in our opinion. The child company that was spun off, the CEO of the child company was actually the CEO of the parent company. So when you're the captain of the boat and you know where this boat is going, like Hari talked about, he's going to look out for himself. So this person, the CEO of Laquinta, jumped ship and is now the CEO of the child company. So that tells you a lot about where the boat is going, I would say.
Yep.
Yeah. Okay, so I think we talked about quite a bit about like downward pressure. I think using Laquinta was probably a good way to kind of illustrate that point. We talked about the downward pressure from indiscriminate selling because people don't want to own a REIT, a real estate investment trust. They only want to own like hotel franchise. So they will indiscriminate sell. That's one thing. Or it might be part of an index. It's no longer part of index. So that's another downward pressure. We also talked about how the incentive management structure is set up so that there's initial sandbagging that happens. Yep. We talked about that. And then because of the sandbagging, people from the outside, the investors will look at this and say, oh, this is really a terrible business. So they start selling. That's another element of downward pressure there.
Yep.
And then we lastly talked about, the CEOs of the parent company and the child company. Where do they come from? We talked about that. So those are things you need to look out for when you're really analyzing stock spinoffs. Yeah. Let's see here. What else? I think this is also interesting. I think this is something that we should also look out for spinoff, which is a future kind of catalytic event that might happen to drive up the price. We talked a lot about downward pressure, but there might be hidden element in the context of the parent company or the child company where you're going to get a huge bump in the future. Obviously, we're going into the territory of kind of predicting the future, but you need to understand that there might be some event that might happen, some catalytic event that happens in the future that will raise up the price.
Yep.
So you need to be looking out for those, not just for spinoffs, really, for any businesses, any investments that you look at, but particularly for spinoffs because there's a lot of downward pressure. And there's a lot of questions around, a lot of, kind of debate around when is the downward pressure going to ease off and when is it going to actually slowly going to come up? When is that bottom trough? Yeah. I don't know, right? So no one knows.
I think the most of the selling that occurs in a company is within the first 6 months. And the timeline is usually can be much faster. It can be much slower. But for as long as I've been investing, I have never seen a company kind of, not realize, Mr. Market gives you an opportunity to sell an undervalued business beyond like 3 or 4 years. Within 3 or 4 years, you will usually see the return that you're looking for if you had if you were correct in your valuation analysis. And I think that's true even in this case of the spinoffs. I mean, in the case of Ferrari, I think the company tripled in like a year, 18 months, something really fast. And in the case of, I think in Marriott's case, it was like even faster, like 6 months. Greenblatt talks about that. So, but a lot of action is going to occur in that first few weeks, that you're going to see the stock price go down because of that indiscriminate selling. And then what you're really looking for is that what is going to, when are they going to kind of clean up all the tarnish and then present a polished product to the market, right? And that's really where you're going to see all of your value come back, is when they clean up all of the rust off of the thing. But if you listen to Monish Pabrai, who's another great value investor, and I think he has a spinoff list. He looks at spinoffs for 5 to 7 years after the spinoff to see unlocked value. So I wouldn't be paying attention to there's obviously a lot of stuff happening in that first few months, but I think even longer term, you can still see some value unlocked from spin-off businesses.
And something that I found interesting when I was doing research on Laquinta was that this individual actually worked at Laquinta. So I got to talk to him. He no longer is there, but he worked at Laquinta. He said this: when executives are trying to spin something off, they will plan this out, 5 years back, 3 years back, and so on and so forth. They'll take quite a bit of time to plan all this out. And when they're planning this out, they'll work with banks. They'll work with Chase Bank or whatever, these bulge bracket banks. And when they approach banks, they'll basically give them a menu. of their incentive structure, or kind of what to do when the spinoff situations. They'll basically advise them, the executives, on what to do. So all these things we talked about, it's sort of baked into the business model of these banks. They'll sell this case for the executives to follow. And so all that to say, this is a real thing, and people are making a lot of money off of this, of the spinoff, both internally, as an operator of the spinoff, but also externally as investors investing in spinoff opportunities. Okay. So I think those are it, for us. Anything else you want to add here, Hari?
No, I know this is a somewhat advanced, topic. I think we'll probably go through a spinoff here in a future episode to kind of give you a more concrete, understanding of what's going on. We will also be preparing our own spinoff checklist, which you can get from us at info@valueinvestor.org or tweeting us at valueinvestortv. So, we encourage you to, to kind of read Joel Greenblatt's book, You Can Be a Stock Market Genius, to kind of look at some of these spinoffs, as a place to start looking for value companies. CorePoint is probably a good one to look at also as a, read their annual report and see where they were from their spinoff and where they're going. But I think it's a great place to look. I mean, if Charlie Munger and Joel Greenblatt are two of the greatest value investors, to walk the earth, say that it's a good place to look, then I think you should pay attention.
Yeah, that's it. Two of the greatest. Many great people actually look into this. So we should also. That's a good point. All right, Hari. Guys, thank you all for listening. Again, if you have any questions or comments about stock market or spinoffs in particular, please reach out to us at info@valueinvestor.org, or reach out to us on Twitter. Our Twitter handle, ValueInvestorTV. And if you can, please go ahead and give us a thumbs up or rate us on Apple Podcasts. That would really help us get more traction. So thank you all for listening, and we'll see you on the next one. Thanks, guys.
Yeah, thanks.